A bank run dealt a lethal blow to Silicon Valley Bank on Friday, March 10, forcing its failure after the U.S. Federal Reserve raised interest rates, scaring away potential investors from the financial institution best known for its relationships with high-flying world technology startups and venture capital. Its downfall is the largest failure of a U.S.-based financial institution since Washington Mutual collapsed at the height of the financial crisis in 2008. So in this video, we are going to discuss the truth of why Silicon Valley Bank collapsed. The video is going to be amazing. Make sure to stick till the end. Now before we get into this video, make sure to hit that subscribe button and leave a comment below saying I subscribed. I will try my best to reply to as many comments as possible. Shed no tears for investors in Silicon Valley Bank. On March 10th, the bank, which had $212 billion of assets, failed with spectacular speed, making it the biggest lender to collapse since the global financial crisis of 2007-09. Most of SVB's depositors were Bay Area tech startups, with accounts holding well in excess of the $250,000 that is insured by the federal government. They had fled, and their panic was rational. By loading up on long-term bonds, SVB had taken an enormous unhedged bet on interest rates staying low. That bet went wrong, leaving the bank insolvent. The fact that shareholders have been wiped out and bondholders will take big losses is not a failure of the financial system. A bad business has been allowed to go bust. It is what happened next that reveals the flaws in America's banking architecture. SVB probably had enough assets for depositors to have got all or almost all of their money back, but only after a long wait. This left many tech firms facing life in a financial deep freeze. Roku, a streaming giant, had nearly $500 million tied up in SVB. Across the technology sector, layoffs and bankruptcies loomed, and America's regulators and the government seemed to fear that depositors were losing faith in other banks too. On March 12th, they judged SVB too big to fail and guaranteed all the bank's deposits. If the sale of its assets does not cover the costs of the depositor bailout, a fund that is financed by all banks will have to chip in, penalizing the whole industry for the recklessness of a single institution. U.S. Federal Reserve increased interest rates. Silicon Valley Bank was hit hard by the downturn in technology stocks over the past year, as well as the Federal Reserve's aggressive plan to increase interest rates to combat inflation. The bank bought billions of dollars worth of bonds over the past couple of years, using customers' deposits as a typical bank would normally operate. These investments are typically safe, but the value of those investments fell because they paid lower interest rates than what a comparable bond would pay if issued in today's higher interest rate environment. Usually, that's not an issue because banks hold on to those for a long time, unless they have to sell them in an emergency. SVB's customers became increasingly cash-strapped. But SVB's customers were largely startups and other tech-centric companies that started becoming needier for cash over the past year. Venture capital funding was drying up. Companies were not able to get additional rounds of funding for unprofitable businesses and therefore had to tap their existing funds, often deposited with SVB, which sat in the center of the tech startup universe. At first, that wasn't a huge issue, but the withdrawals started requiring the bank to start selling its own assets to meet customer withdrawal requests. Regulators shuttered Signature Bank on March 12 after its depositors had withdrawn billions following the collapse of SVB, another regional bank, 2 days prior. Signature's stock also sank in its last day of public trading before the bank was shuttered. SVB sold its bond portfolio at a loss. Because SVB customers were largely businesses and the wealthy, they likely were more fearful of a bank failure since their deposits were over $250,000, €234,575, or the U.S. government-imposed limit on deposit insurance. That required selling typically safe bonds at a loss, and those losses added up to the point that SVB became effectively insolvent. The bank tried to raise additional capital through outside investors, but was unable to find them. A bank run sank the ship. The fancy tech-focused bank was brought down by the oldest issue in banking and one of the few means that can surely tank a bank: a run on it. Bank regulators had no other choice but to seize SVB's assets to protect the assets and deposits still remaining at the bank. Benzinga. Almost everyone has heard by now that one of the biggest banks focused on serving startups and innovative tech companies collapsed in a matter of days, but a lot of things played into its eventual destruction. Here's a look at what ultimately led the US government to step in over the weekend. What happened? The biggest banking collapse since the 2008 financial crisis was spearheaded by a bank run on SVB Financial Group, Nasdaq, SIVB. Last week, but the gears had been turning for quite some time. Much of the problem stemmed from a combination of a short-lived surge in cash positions and a swift attack on inflation by the Federal Reserve. The setup: SVB Financial, the parent company of Silicon Valley Bank, counts many startups and smaller tech companies as clients. Deposits from these clients soared during the pandemic, as many of them grew their cash positions exponentially amid record low rates. As deposits climbed, SVB decided to buy U.S. Treasuries and government-backed mortgage securities with the influx of cash. The catalyst: as the U.S. emerged from the pandemic with a flourishing economy, inflation started to dig its teeth into hard-working Americans' pockets. With inflation rapidly rising across the board, the Fed raised its fists and began to jab at rising prices with a series of aggressive rate hikes. The effects of higher rates lagged behind in inflation readings, but several companies started to feel the pain as investors backed out of high-growth names and cash positions began to dwindle. The tipping point: given the rising rates environment, inflows turned to outflows, and SVB was forced to sell some of its longer-term treasuries at a loss to cover increased withdrawal requests. SVB sold out of its bond portfolio, worth approximately $21 billion, and recognized a loss of $1.8 billion, according to a release from last week. The portfolio was yielding just 1.79%, while the 10-year was yielding closer to 4%, per Reuters. SVB also went to the public markets to raise additional capital, announcing plans to offer $1.25 billion of its common stock and $500 million of depositary shares. As a result of the announcement, the stock tanked, which put more pressure on the bank. The panic in the market sparked a bank run as several customers rushed to withdraw capital, and ultimately, the bank's cash position ran dry. SVB then looked to find a buyer in order to source alternative funding, but the Federal Deposit Insurance Corporation, FDIC, shut it down and placed the bank under receivership, according to Reuters. The government steps in. Over the weekend, the Fed stepped in to inject liquidity into the situation in an effort to make depositors whole. However, the bank itself can be chalked up as a zero. Depositors will be covered by the FDIC's Deposit Insurance Fund. Furthermore, the Fed also announced plans to create a new bank term funding program centered around protecting institutions impacted by the crash of SVB Financial stock. It's not a bailout, so shareholders will not recoup losses and taxpayers will not suffer. The move simply aims to build back confidence in the banking system, Fed Chair Jerome Powell, Treasury Secretary Janet Yellen, and FDIC Chair Martin Gruenberg said in a joint statement. The U.S. banking system remains resilient and on a solid foundation, in large part due to reforms that were made after the financial crisis that ensured better safeguards for the banking industry. What happens now? At the moment, experts don't expect there to be any issues spreading to the broader banking sector. There might be some pockets of instability caused by this, as seen in the dip the crypto market took on Saturday morning, but showed signs of recovery later in the day. SVB was large, but had a unique existence by servicing nearly exclusively the technology world and VC-backed companies. It did a lot of work with the particular part of the economy that was hit hard in the past year. Other banks are far more diversified across multiple industries, customer bases, and geographies. However, there might be economic ripple effects, especially in the U.S. tech startup world, if the money that was deposited at SVB can't be released quickly? Let us know your opinion in the comments section below. This was all for today. Hope you liked the video. Subscribe to our channel and stay tuned for more interesting videos. Stay safe, and we will be back soon with another video.